We've seen how Beijing has attempted to change the status quo on Taiwan for some time.
We also see a coordinated effort across the Chinese government to lie, cheat, and steal their way into unfairly dominating entire technology sectors.
For many, many years, there was a basic understanding when it came to Taiwan. What changed is this. The government wanted to speed up the reunification.
解决台湾问题是中国人自己的事，要由中国人来决定。我们坚持以最大诚意，尽最大努力，争取和平统一的前景，但绝不承诺放弃使用保留采取一切必要措施的选项。
We're committed to doing everything we can to make sure that Taiwan has the ability to effectively defend itself against aggression.
The relationship between the U.S. and China, the two largest economies in the world, is going from bad to worse with every passing week. It is not an exaggeration to say that U.S.-China relations are worse than they've ever been since diplomatic relationships between the two countries were established back in 1979. So much has happened in 2022 that it's difficult to see how things can ever go back to where they were, regardless of whether a hot war breaks out between the two superpowers. Economic decoupling is no longer a question of if, but of how. What does this mean for growth, inflation, interest rates, stock market valuation, and home prices? What will be the new safe haven in the new Cold War? What does it mean for your money? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. The economic divorce between the US and China is playing out literally in front of our eyes. While its implications are still being hotly debated, one thing is clear. This event will have consequences more profound than anything we've seen over the past 20 years. And nobody will be able to escape its consequences. Some people are applauding what is happening. They think it was a big mistake that the United States backed China's entry into the World Trade Organization 20 years ago. To them, that mistake was the reason why many blue-collar workers in developed countries like the US and Europe lost their jobs or saw their wages decline in real terms. Others think that China got the better end of the bargain. They think it wasn't fair that China's integration in the world economy lifted 1 billion Chinese people out of poverty while the standard of living in the US stagnated. I do not want to suggest that these people are wrong. However, even if they're right, it is too late to undo what happened. Indeed, undoing the economic integration between the US and China would be costly for everyone, very costly. And it is not clear that it will be more costly for the Chinese than for the Americans. One way to think about what really happened on the eve of China's entry into the World Trade Organization 20 years ago is that suddenly 400 million Chinese workers who were either unemployed or underemployed, many of whom were living in rural villages, suddenly joined the global labor force. For multinational corporations, this represented a huge opportunity. If they could only tap into this pool of cheap labor, it could help them cut costs and improve their profit margins. So they did what you would expect profit-driven companies to do. They started to move their supply chains to China. As a result, US imports from China started to swell while US corporate profits took off. For US households, the economic impact of the integration of the surplus Chinese labor in the world economy was more mixed. A 2020 analysis by the nonprofit Economic Policy Institute, a labor-oriented think tank, estimated that increased US trade with China resulted in the loss of 3.7 million jobs between 2001 and 2018. I would also add that even those workers who didn't lose their jobs did lose their wage bargaining power. The number of union workers in the US fell from 16 million to 14 million over the past 20 years. As a result, real wage growth declined. However, there were some positive offsets. A 2019 analysis concluded that each U.S. household saw its annual purchasing power increase by $1,500 thanks to lower prices caused by increased trade with China from 2000 to 2007. For financial markets, the impact was much more straightforward. Lower import prices and lower wage growth meant lower inflation. For the bond market, lower inflation meant, of course, lower interest rates. To the extent that increase in interest rates in response to inflation is often the main reason why we have recessions, lower inflation also meant lower frequency of recessions. For the stock market, the combination of improved corporate profit margins, lower discount rate for future earnings, and lower frequency of future recessions meant higher valuation. For the housing market, lower interest rates more than offset lower wage growth, and prices of homes began to surge around the world. Arguably, the most important consequence of China's integration into the world economy was the massive increase in wealth of U.S. households as the prices of their holdings of bonds, stocks, and homes skyrocketed. The net worth of American households increased from $40 trillion to $140 trillion over the past 20 years. That's an increase of $5 trillion a year. The story could have had a happy ending. After all, poor Chinese people became less poor. After all, Americans became even more wealthy. To ensure a happy ending, what successive U.S. governments should have done was to tax those Americans who profited obscenely in making out like bandits in order to help those Americans who lost their jobs to China and who didn't own any stocks or houses. What American government should have done was to get the American millionaires and billionaires who became even richer to help, one, pay for the retraining of those who lost their jobs to China so that they could become competitive again. And two, invest massively in American education for the U.S. to maintain or even increase its technological lead over China. Put differently, U.S. administrations over the past 20 years, Republican and Democrat, could have used the financial windfall from China's integration into the world economy to reduce income inequality at home and to make Americans' workers more competitive. But they didn't do it. Thanks to the warmongering neocons around George W. Bush, the U.S. decided to use that financial windfall to invade Iraq and Afghanistan, of course. The Watson Institute at Brown University estimates that the post-9/11 wars have cost the U.S. federal government over $8 trillion, not to mention the energy, the focus that the U.S. government had to devote to these wars. It is ironic that the same neocons have found favor in the Biden administration and are now advocating an aggressive confrontation with China and Russia in the name of human rights and democracy. As I discussed in my video last week, they have just helped push through the most stringent controls ever of U.S. technology exports to slow China's technological development. There are many signs that decoupling between U.S. and China is happening at a rapid pace. Bilateral trade between the two countries as a share of their overall trade is declining. U.S. direct investment into China is falling as a share of total outward U.S. direct investments. In the first 6 months of 2022, the number of student visas issued to Chinese nationals decreased by more than 50% compared to 2019. The share of U.S.-China collaborations in all global cross-border collaborations of leading scientific journals has fallen from 10% to 8% in the last 3 years. The increasing number of listed Chinese companies relocating from New York to Hong Kong. These developments will have an important long-term impact. But what about the short-term impact? And in what way is this decoupling already having an impact? Due to increased tension between the two countries, many American companies are bringing their jobs back to the U.S. According to a report published recently by the Reshoring Initiative, American companies are now on pace to reshore nearly 350,000 jobs this year. That would be the highest number on record since the group began tracking the data in 2010. This is clearly adding to the tightness in the U.S. labor market, with the U.S. unemployment rate already at an all-time low at 3.5%. Indeed, the record low unemployment rate is the reason why wages are growing at their fastest rate in more than 20 years. High wage growth is the reason why U.S. inflation remains stubbornly high despite the easing of supply chain disruptions. High wage growth is also forcing the Fed to hike interest rates aggressively. High wage growth is the reason why 30-year mortgage rate has doubled this year to reach 7.2% this year. High wage growth is pressuring corporate profit margins at the same time. It is no coincidence that in the midst of the economic decoupling between the US and China, we are seeing rising interest rates and falling stock prices and home prices. A huge puzzle is the fact that US labor participation rate has not recovered to the level before 2020. Currently at 62.3%, it is a full percentage point lower than in February 2020. Why have so many millions of Americans who left the labor force during the lockdowns opted not to return? This is puzzling because there are now 10 million job openings and wages are high. One possible explanation is that the U.S. is suffering from a skill mismatch, that those who have chosen to leave the labor market simply do not have the education or skills to qualify for many of the 10 million job openings. That the U.S. government has failed to invest in education to upgrade the American labor force to prepare for this day. There's plenty of anecdotal evidence supporting this hypothesis, even though it is impossible to know how important it is for the overall labor market. Nevertheless, it does reinforce the view that the decoupling between US and China will likely lead to higher interest rates, stagflation, and lower asset prices. In other words, the economic outcome of the new Cold War is likely to be worse than what we are now. All this is bad news for the US economy. My money is that the correction in the stock market has not yet run its course. If you got something out of this video, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come check us out at davidwuunbound.com. Thank you for listening.